traders and friends, market participants and enthusiasts right around the world. Thanks for joining me on this Monday afternoon market recap. The Dow Jones Industrial Average along with the SP 500 and the Nasdaq are continuing to be a little bit disobedient, or in other words, a little bit crazy. Today, the industrial average closed up just shy of 400 points. This equates to about a 1.5% rise. And what makes this even more interesting and compelling at this particular juncture is that we have also overshot this Fibonacci resistance area coming in at 61.8%. Now, you might be asking, what does 61.8% actually mean? Simply all this is a range, or at least a measure, a percentage measure of the sell-off, which began up here on the 29th of January through to the bottom, or at least that candlestick that we have to actually warn us where that low essentially established itself from, or off from. This is on the 9th of February. So this equates to 100%. And then, of course, this bounce that we're currently underway, this line on my screen is equating to 61.8%. So we've overshot this. We're closing at 25,709. To me, this has come as a surprise. Generally, when we come back up into these resistance areas, now again, the top equals 61.8, the midpoint is 50, and the bottom is 38.2%. We generally stall here as resistance, which also correlates with this falling 18-day simple moving average. And then generally what we see is the market actually test for the second time that intermediate bottom. And this is where we generally phase, or at least enter into those bounce buy positions as we take the swing back on up to fill these gaps which have opened at the beginning of the sell-off, which began to take place at the end of January, this gap over here. Now, as it stands, again, the market is being a little bit disobedient. What it is essentially carving out right now is that of a V bottom. And I will say that V bottoms, although this isn't technically perfect, and what I mean by technically perfect is that it's not showing up at the right location. V bottoms generally show up at the end of an exhaustion move, at the end of a bearish cycle, or that of a bearish trend. Now, obviously, this is not a bearish trend. This is a very abrupt sell-off, and largely equated to all of the exhaustion types of moves, or just the overbought state of the market as we rally back up to retest this pivot at 26,300, which of course is that decelerating fan line, and really a trend, a big macro trend, which has been in effect since the beginning of the '09 low and what has been the bull market since. So we're running through, of course, the ebbs and flows of the market generally. When you see these types of candlesticks at this Fibonacci resistance area, the market will roll, it'll come back down and retest the support area. And again, this is where we will execute a lot of the bullish trades. This isn't the case. And again, this is why it is a little bit surprising to me. Personally, I can say, in full transparency with you, I do not have a single open position on the diamonds, on the Qs, or on the SPYs. Yes, we did trigger above 25,470, but this is a dotted line. And the reason why it's a dotted line is because the risk and reward at this level is simply unjust. If you have a look at the target on this trade, it's sitting up here at 26,435. There is still, of course, the possibility that we reverse somewhere around this location. It's going to be very interesting to see how tomorrow's candlestick unravels, whether or not we get another continuation to the upside. If we do see that on Tuesday, well, then we can assume that we are going to come on back up and close this gap. And then this is where we're going to set the bidirectional trades up, maybe towards the end of this week, even in this weekend's pro analysis class. But at the moment, don't feel frustrated if you're not actively in the market, or if you don't find yourself chasing a bunch of positions. The market is acting a little bit out of sync of generally what happens when you go through these major retracements. And as such, if you don't find yourself, of course, chasing trades or taking a bunch of risk at the moment, you should really be congratulated for that, for remaining disciplined and following a trading plan that will keep you out of the market when it's necessary, but also limiting you of capital being placed into, decent trades. And that's essentially what is, our environment at the moment, or at least our circumstance as we continue to follow along with these markets. I'm simply quite amazed at this candlestick construction, which is sort of formed off from, or at least began on Friday last week. Again, the continuation during Monday's session, up just shy of 400 points, another strong session and advance to the upside. But when you look at these candlesticks, again, hangman at resistance, shooting star, dark bearish candlestick, another shooting star, all of the reversal signals were here, but we never flinched below 24,740. We had a good trade set up back down to the support lows. It didn't trigger. We didn't lose a single penny, but at the same time, this is where it gets a little bit frustrating. So again, you should be congratulated for not placing a bearish trade. And if you're not in this to the upside, you should also be congratulated because again, the risk and reward really doesn't fit or at least work out all that well when you consider placing your stop below the low of Wednesday's candlestick last week for the breakout trigger at 25,470 up to 26,435. Now, what is interesting about this, I mean, everything I've said about the industrial average is applicable to the S&P 500. Also, a lot of people are calling this that of a bull flag. This is not a bull flag. The reason it's not a bull flag is because this is not a bullish trend. All right. If this type of pattern simply occurred over here during that of the bullish advance, right, when we were in that defined bullish uptrend, just like this, well, then this is a bull flag. But this right here is not that of a bull flag. This is a corrective type of bounce, which is currently under construction. Now, what I was saying is that the Nasdaq has pretty much made back all of the losses that we first established in the month of February. So if you look at this and look at where we opened on February, we were all the way up here above 7,350. We made that intermediate low down here at 6,630. That was the absolute bottom of the sell-off on the Nasdaq. And as at the close today on Monday, we're actually above the first trading session of where we were on the first trading session of February. So you can see the Nasdaq is powering higher. What's interesting about that is we got very close to closing this gap between this candlestick just here and of course this candlestick here. We didn't close it by a couple of cents. It's almost guaranteed that we are going to close this now, and this is really where the next crop of directional trades are going to stem from when we apply that to the Qs. It's also going to be the same for the diamonds as well, which is applicable to the Dow Jones Industrial Average and also the S&P 500. But you can see that there is a little bit of lag between that of the Nasdaq. Again, we're very close to coming back up and retesting this resistance at 7,500. But on the industrial average, we have a little bit further to go. You can see we're only closing at 25,709, and we still have a couple more points, a lot more points, specifically just under 1,000 points until we get back, of course, to close this gap. The same is true for the S&P 500. Quite a distance to move until we close this gap. Now, when it comes to the individual trade setups, you have to understand, first of all, where we are with these markets. These markets have not broken above this resistance level over here, or at least their respective swing high resistance levels. You can see that all of these three markets are still positioned below the lows where we were towards the late stages of January 2018. So first of all, we have to allow these markets to break out above their respective highs until we get real market confirmation that these markets are going to move higher. At the moment, there is still the potential, and this is what is a little bit concerning, is that because we've sold off and also rallied so quickly, which is essentially forming this V, it makes me sort of, I guess, ask the question, because we haven't come back down and sustainably retested this intermediate level just here, and this is across the board for the Nasdaq, the Dow Jones, and the S&P 500, it's got me, I guess, asking the question, well, if we're simply making this very volatile and aggressive V bottom, does this raise the chances and the probability that we're actually going to fail slightly lower than this resistance area over here at 7.5 and potentially set up that of another roll, okay, and that of a larger double top pattern? And that's the question again that, of course, I don't have answers to at the moment, but it is a very valid question. All right, so think about this. Because we haven't gone through the natural ebbs and flows, the general cycle of the market after entering that of, a major sort of, pullback at least, because we haven't seen this occur, and then, of course, the more sustainable bounce moving forward, which is where we were going to enact a lot of individual trades, are we going to see some fireworks essentially set up at higher levels? So again, when the time is ready, all right, we're going to get up to this point. We're going to set up or at least talk more in depth about the bidirectional trade opportunities. But at a minimum right now, I would encourage you to think about the potential of this market rolling at this level and what it means if we come on back down to 6.9 or overshoot it back into these larger macro bullish trends. So time will tell whether or not this is a viable sort of option, or at least the option, or at least the pathway that the market is going to take. But what I would say to you right now, because of this type of price action, I think the probability and also likelihood of this type of move setting up from this resistance area, once of course we close this gap, is going up, and it is something that you should be aware of at this particular moment. Now, because of that, you obviously have to ask yourself the question, what do you do with these individual trades? I mean, you've got Apple very close to breaking out. Do you have the Nasdaq confirming this move? No, you don't. However, it is still a pretty decent trade setup because we still have a couple of points on Apple moving forward. So the 179.89 trigger is still relevant, but at the same time, it would be good to see the Nasdaq actually break out above its respective resistance area. Amazon today broke out above 1,508. I am not in this trade. I chose not to take it. I spoke about this over the weekend. I said I'd like to see at least an upper wick or a dark candlestick to show up around this breakout pivot. Because the Nasdaq is very close to its resistance area, it doesn't bother me. We're up $21.93. If you wanted to move this trigger up, you can still do it. But what I spoke about over the weekend still stands. I would like to see a definitive resistance area form before I jump into this stock at this price, and especially using that of derivative contracts. So I just wanted to make that very clear as well. It's okay to be disciplined. It's okay to miss out on these sort of knee-jerk reactions because the larger picture itself still isn't all that set up for a larger sort of movement, or at least bullish breakout of these highs at the moment. That might change, but at the moment you've got a couple of stocks which are jumping the gun a little bit, and I suspect that we are going to enter into at least a short-term pullback on these individual stocks once these indices themselves come on back up and retest that resistance area. Boeing Airlines hasn't touched or at least moved above 365, so there's no update there. Baidu is continuing, but at the same time, it's still not above any of these swing highs, or at least that last pivot. Caterpillar continuing up $1.28. We are still moving into this Fibonacci retracement box. The same is true for the markets, but Caterpillar is still within it. We have a little bit of temporary resistance at that 61.8 retracement, but not enough to suggest that this is going to reverse. So expect this to continue to climb higher. I'm personally not looking to jump into it. Again, the risk and reward is a little unstable, or at least it's not set up well enough for me to actually be pondering this. COP is still moving sideways, sort of dancing around at that 5703 pivot. You have to allow a little bit of time. CVX triggered today. This is the only trade that did trigger above 113.54 that I'm happy about. This is something that you're going to have to, again, think about more so long term, because as the market runs up into that resistance area, you're probably going to see a little bit of resistance form, but a pretty decent trade. I like this trade on CVX. 113.54 was the entry. We're at 114.60 at the moment. So a quick dollar there today on CVX, but if the market is anything to go by in a lot of these individual trades, you can see the levels on my screen, 61.8, the 0.5 and the 0.382 retracement. This is pricing us up at 118, 121 and 123, almost 124 respectfully. So some pretty decent profits on CVX if it chooses to run, and a really nice risk and reward sort of breakdown. So that's the type of trade that I would gravitate to. And I'd encourage you to start looking into CVX if it chooses to pull back and you're fortunate enough to start positioning yourself into that. Google, I'm not interested in. It's closing the gap at the moment. It's going to probably be very volatile in this red box. We do have another long day Morobozu, which is interesting, but no actual trade triggered there on Google. Goldman Sachs is coming back up into this resistance area just above $273 per share. It's actually closed at 271.26, so it's got a couple more bucks to go, but all in all, I'm not all that interested in it. IBM is largely going nowhere. Again, this is not a bull flag. We got a pretty healthy day today, up $3.06, but that is obviously aided by the broader markets themselves, especially the industrial average, which again closed up 1.5%, just shy of that 400 round point mark. Netflix is looking to break out. The problem with Netflix and also Amazon is that we don't have selling at the moment. Now, again, a lot of people are probably jumping into this. Ask yourself the question, what is volume doing on Amazon? And also, what is volume doing on Netflix? Are we seeing any large expansionary volumes as we break out above this swing high? And the answer to that question right now is no. So personally, I'm waiting for a dark candlestick or at least an upper wick to form, which I think is going to happen once these markets come and push on back up into their respective resistance areas. And that's going to be the test, or at least the moment of truth on these individual stocks as well. And Tesla today rallied another $5.37. We're coming back up to these past two resistance swing highs. Now, what is most interesting to me outside of these individual shares, if my charting software wants to work with me, just bear with me. It's loading up the US dollar, by the way. Here we go. You can see for yourself that the US dollar appears to be setting up that of a W, right? Otherwise known as a double bottom. This is what we call a W for winner. These are the types of trades that when they set up during and in the right location, as you can see, we are in a defined downtrend. This is generally where we get that intermediate sort of release as this individual stock market, industry, currency, this of course being the dollar index, rallies on back up to produce that next lower high. So as this is under construction, yesterday we do have a little bit of a hangman at resistance. We haven't definitively broken above this little swing high over here. If the US dollar is to continue higher, then you have to expect, of course, gold and silver to continue to pull back. Now, again, today they were relatively flat. Gold was up 32 cents. This is what we call another doji candlestick. It is essentially in no man's land at the moment between 127.50 and 124.50. But I do believe once the US dollar makes that top, all right, if it continues to accelerate to the upside and then it begins to set up or at least price in that next consecutive lower high, as of course silver and gold continue to pull back, we should have some pretty decent buy opportunities at lower prices. Of course, there can be sort of market noise, market volatility. We can always see, of course, gold and silver spike for a couple of sessions, but really sort of the intermediate trend of at least silver and gold and commodities at the moment is down, and that of the US dollar is up. And what that means is that you have to remain patient because you're going to have a better opportunity to price yourself into gold and silver, and also a higher price to short the US dollar if you're not willing to trade this long above 90.61, or if you didn't take the trade here, or if you didn't take the trade here. So I just wanted to throw that in there as well. There's a lot happening with US financial indices, also individual trades. For the large portion of this, personally, I've not been active in any of this bounce. I really set really strict criteria to actually jumping into these types of trades, because during these market movements there is a lot of volatility, which leads to a lot of whipsaws in the world of swing trades. So you really have to be quite calculated and have a really disciplined approach to following your trading plan, which is going to guide you in making the best decisions moving forward. It's okay if you're not in directional trades. It's actually the best option. V-bottoms are almost impossible to trade. They really are. Unless you're purely speculating somewhere around the lows. You want to see a little bit more, I guess, a little bit more framework, and again, just allow a little bit more in the form of criteria to build, or at least a blueprint and the nucleus of the trade to form, until you start pulling the trigger. And don't feel frustrated if you're not in above 25,470. Just as easily as we rallied 400 points on Monday, we can sell off 600 come Tuesday. I'm not calling for that to happen, but the better trade, or at least the better risk and reward parameters, are going to set up from this location up here at 26.5, or they're going to set up back down here closer to 24,000 on the industrial average, and the same is true for the Nasdaq and the SP 500. So I hope that helps you. As at the close on Monday, it is a little bit longer than what I would genuinely or generally like to talk about in terms of a time frame. So I'll end it there. If you have any questions, please email me, success@pivotpoint-trading.com. Until next time, and I will leave you with another market update tomorrow. Enjoy your evening, everybody, and I'll see you tomorrow. All the best. It's James signing off on behalf of Pivot Point Trading. Farewell.